Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing the significant jump in home sales in Toronto, as reported for the month of November. According to the Toronto Regional Real Estate Board, home sales surged by 40.1% compared to the same period last year. This remarkable increase is attributed to the recent interest rate cut by the Bank of Canada in October, which has seemingly revitalized buyer interest. The average selling price in the Greater Toronto Area rose by 2.6% year over year, reaching $1,106,050. However, the composite benchmark price, which is designed to represent the typical home, actually saw a slight decline of 1.2% compared to last year. This indicates a mixed picture, where selling prices are still below their historic peaks, but there's a trend towards market recovery. Jennifer Pierce, the president of the Toronto Regional Real Estate Board, expressed optimism about the market's future. She noted that as selling prices remain below their all-time highs and monthly mortgage payments decrease, the conditions are ripe for an accelerating market recovery in 2025. It's interesting to see that this trend isn't limited to Toronto. Other cities, such as Vancouver, are experiencing similar increases in home sales. Nationally, sales figures have been on the rise, marking a shift from the previous holding pattern as the Bank of Canada continues to lower its key interest rate. Go, a sales representative with Big City Realty Inc. brokerage, pointed out that the October rate cut was the pivotal moment the market needed. She highlighted that many buyers had been waiting on the sidelines for rates to drop. With the recent cut, there's renewed hope that another rate reduction in December could further boost market activity. In November, the Greater Toronto Area saw 11,592 new listings, a 6.6% increase from the previous year. Sales in the City of Toronto itself rose by 40.5% compared to last year, with the rest of the Greater Toronto Area seeing a 39.8% increase in home sales. Jason Mercer, the chief market analyst for the Toronto Regional Real Estate Board, noted that market conditions have tightened, especially for single-family homes. Interestingly, the detached homes market experienced price growth exceeding the rate of inflation, particularly in the City of Toronto. While the detached homes segment is seeing price growth, the condominium market is experiencing a different trend. Condo buyers are benefiting from a wide range of options and significant negotiating power, leading to lower average selling prices compared to last year. This situation could potentially attract more renter households into home ownership as borrowing costs continue to trend lower. Overall, all property types saw higher sales in November compared to last year, led by a 46% increase in townhouse sales, a 43.9% rise in detached homes, and a 36.3% increase in condo sales. Semi-detached homes also saw a 24.9% increase in transactions. Darren King, an economist at National Bank, noted that the highest level of transactions since May 2023 occurred in November. He suggested that while continued interest rate cuts could support the housing market, the recent rise in long-term bond yields might impact fixed mortgage rates. King also pointed out that sales are still 21% below pre-pandemic levels, and ongoing affordability challenges and a weak labor market in Toronto could limit the housing market's recovery. Go also expressed concerns about the upcoming mortgage renewals and the potential for layoffs as we approach 2025. A weaker labor market could lead to an increase in listings, which might affect the buyer market. If layoffs increase, it could slow down the economy, impacting both buying and selling activities. The Greater Toronto Area's housing market has continued its upward trajectory, as home sales in November saw a significant increase compared to the previous year. According to the Toronto Regional Real Estate Board, 5,875 homes were sold across the Greater Toronto Area last month, marking a 40.1% rise from the 4,194 homes sold in November of the previous year. This increase can be attributed to the recent interest rate cut by the Bank of Canada in October, which has played a pivotal role in attracting buyers back into the market. On a month-over-month basis, sales were up by 1.9% from October, when adjusted for seasonal variations. The average selling price rose by 2.6% year-over-year, reaching $1,106,050. However, the composite benchmark price, which represents the typical home, declined by 1.2% compared to the same period last year. This decline is a much smaller rate of decrease than what was observed in previous months, indicating a stabilizing market. Jennifer Pierce, president of the Toronto Regional Real Estate Board, expressed optimism about the market's future, stating that with selling prices still below their historical peaks and monthly mortgage payments trending lower, the conditions are favorable for an accelerated market recovery in 2025. The trends in the Greater Toronto Area are consistent with those seen in other major cities, such as Vancouver, where home sales increased by 28.1% year-over-year. Nationally, sales figures have been on the rise, reflecting a shift from the market's previous holding pattern as the Bank of Canada continues to lower its key interest rate. The central bank is anticipated to cut rates for the fifth consecutive time at its final meeting of the year on December 11th. Currently, the rate stands at 3.75%, down from the 5% level earlier in the year that had deterred many potential buyers. Vi & Go, a sales representative with Big City Realty Inc., brokerage, noted that the Bank of Canada's half percentage point rate cut on October 23rd was the catalyst the market needed. She pointed out that many buyers had been waiting for rates to drop, and with this cut, there's renewed hope that another reduction in December will further stimulate market activity. In November, the Greater Toronto Area saw 11,592 new listings, a 6.6% increase from the previous year. The City of Toronto itself experienced a 40.5% jump in sales, while the rest of the Greater Toronto Area saw a 39.8% rise in home sales. According to Jason Mercer, the chief market analyst for the Toronto Regional Real Estate Board, market conditions have tightened, especially in the single-family home segment, where the detached market experienced price growth exceeding the rate of inflation, particularly in Toronto. In contrast, the condominium market continues to see lower average selling prices compared to a year ago, as condo buyers benefit from a wide range of options and significant negotiating power. This situation is expected to attract more renter households into home ownership as borrowing costs continue to trend lower in the coming months. All property types saw higher sales in November compared to last year, with townhouses leading the way with a 46% increase, followed by detached homes at 43.9% and condos at 36.3%. Semi-detached homes also saw a 24.9% increase in transactions. According to Darren King, an economist at National Bank, these transactions reached their highest level since May 2023, a time when the Bank of Canada had paused its rate hikes. Darren King also emphasized the need to consider the impact of the recent rise in long-term bond yields, which could affect fixed mortgage rates despite the short-term interest rate cuts. He noted that while sales figures are still 21% below pre-pandemic levels, persistent affordability challenges and a weak labor market in Toronto could limit the extent of the housing market's recovery in the region. Vi & Go expressed concerns regarding upcoming mortgage renewals and the potential for layoffs as we near 2025. She highlighted that a weaker labor market tends to lead to an increase in listings, which could impact the buyer market. If layoffs increase, it could slow down the economy, affecting both buying and selling activities. In the Waterloo Region, real estate agents have reported a noticeable increase in home sales for November compared to the previous year, although prices have fallen. The Cornerstone Association of Realtors, which is one of the largest real estate boards in Ontario, released statistics showing a 21.1% increase in homes sold in November 2024 compared to the same month last year. However, the sales figures are still 13.1% below the 10-year average for November. The total number of homes sold via the Multiple Listing Service, MLS, in November was 539, which is an improvement from last year's numbers, but down from October's 610 sales. According to Crystal Mora, A spokesperson for the Cornerstone Association, the market has shown more balanced conditions with an increase in available homes, providing buyers with more options. Despite the increase in sales, the average sales prices for all residential properties in the region saw a decline. The average price for these properties was $754,604, which is a decrease of 3.3% from October and a slight dip of 0.2% compared to November 2023. Detached homes in particular saw their average prices fall to $862,690, down 2.6% from October and 3.1% year over year. Sales were up across all property types except for condominiums, which experienced a 17.7% decrease in sales compared to last year. This trend indicates that while the market is more favorable for buyers, especially with increased inventory, the condo market is facing its own set of challenges. The current market conditions, characterized by increased inventory and stable prices, suggest that it might be an opportune time for potential buyers to enter the market. This is particularly true for those who can take advantage of lower interest rates and recent federal mortgage reforms. These reforms include increasing the price cap for insured mortgages to $1.5 million and allowing buyers with less than a 20% down payment to qualify for a mortgage. Moreover, all first-time homebuyers and those purchasing new builds are now eligible for a 30-year amortization period, which can lower monthly mortgage payments, though it may result in higher interest payments over the life of the loan. The Bank of Canada has been gradually lowering its key overnight interest rate, currently standing at 3.75%, with another rate decision expected on December 11th. The local MLS system saw 889 new listings added in November, marking a 2.4% increase over last year and an 18.4% rise above the previous 10-year average for the month. By the end of November, there were 1,565 homes available for sale, representing a 20% increase compared to last year and nearly 58% higher than the 10-year average of 992 listings. Currently, the region has a 2.8-month supply of all property types, indicating the time it would take to sell the current inventory at the current pace. The highest inventory levels are seen in the condo apartment segment, with a 5.9-month supply. On average, it took 27 days to sell a home last month, which is consistent with October's timeframe, but longer than the 5-year average of 19 days. Mississauga's real estate market has recently experienced significant declines, particularly in home prices, as reported for the month of November. According to the latest analysis from the Toronto Regional Real Estate Board, the average price of all home types in Mississauga dropped by 8.07% to $994,634. This comes after a modest rise of 3.2% in October, when the average property price was $1,081,951. Real estate brokerage Zoocasa provided further insights, noting that the total sales in Mississauga fell by 22.88% to 445 transactions. The decline in sales and home prices aligns with the typical seasonal pattern observed in late fall and winter, where market activity tends to slow down. The report highlighted that the average price of a detached home saw a substantial decline of 11.47%, bringing the price to $1,425,730. This shift reflects the current market conditions, where buyers are often in a stronger position to negotiate due to the seasonal slowdown. New listings for detached homes also decreased by 19.07% to 365 units, and the average days on the market increased by 8% to 27 days. Sales of semi-detached homes in Mississauga experienced a notable decline of 22.89%, with only 64 properties sold. Zoocasa noted that this property type tends to be less popular in Mississauga. The average price for semi-detached homes dipped slightly by 2.70% to $981,406, while new listings decreased by 17.56% to 108. The average days on the market for these homes rose by 13.64% to 25 days. The combined segment of townhouses and condo apartments presented mixed results. The average price for townhouses fell by 4.14% to $934,357, whereas condo townhouses and condo apartments saw slight price increases. Specifically, condo townhouse prices rose by 0.55% to $797,250, and condo apartments showed resilience with a 4.60% increase, reaching $615,750. Despite the price gains in some segments, sales declined significantly across all subtypes. Freehold townhouse sales plummeted by 53.57% to just 13 transactions. Condo townhouse sales decreased by 12.24% to 86, and condo apartments saw an 18.83% drop to 125 sales. New listings also decreased across these property types, with townhouses down by 16.67% to 35, condo townhouses down by 17.22% to 173, and condo apartments down by 16.70% to 379. The inventory for these property types is staying on the market longer, with townhouses experiencing the largest increase in listing days, rising by 13.04% to 26 days. Condo townhouses saw an increase of 13.79% to 33 days, and condo apartments had a slight rise of 2.86% to 36 days. Overall, the market's inventory has tightened, with new listings down by 18.01% to 1,061 and active listings declining by 5.12% to 1,981. Despite the current downturn, experts remain optimistic about a market rebound in the spring. Jennifer Pierce, president of the Toronto Regional Real Estate Board, expressed confidence that with selling prices still below their historical peaks and monthly mortgage payments trending lower, the market is poised for an accelerated recovery in 2025. Penelope Graham, a mortgage expert with Ratehub.ca, recently shared her insights on the impending Bank of Canada interest rate announcement scheduled for December 11th. According to Graham, all indications suggest another interest rate cut is on the horizon, which could be beneficial for those looking to enter the housing market. Graham pointed out that Canadian citizens and businesses are increasingly feeling the effects of what she describes as a Me-cession and the steep cost of living. She noted that Canada's gross domestic product growth is underperforming relative to the Bank of Canada's forecast, although inflation remains within the target range set by the bank's governor, Tiff Macklem. Another factor contributing to market uncertainty is the looming tariff threats from the United States President-elect Donald Trump, which could impact the bond market and the value of Canada's dollar. Despite these concerns, Graham believes there's room for another interest rate cut. From a homebuyer's perspective, the anticipated rate cut could make it more affordable to enter the market. As lenders' prime rates and variable mortgage rates are likely to decrease following the Bank of Canada's announcement, new amortization and insured down payment rules are set to come into effect shortly after. Starting December 15th, the insured mortgage cap will rise to $1.5 million, and buyers of new homes with an insured mortgage can apply for a 30-year amortization rate. Graham predicts that these changes could lead to a hot January selling season once the holidays are over. She advises anyone shopping for a new mortgage or renewing an existing term to consult with a mortgage professional to strategize as the market heats up. Ratehub.ca has conducted a general calculation to illustrate potential savings if the Bank of Canada cuts interest rates by 25 or 50 basis points. For instance, with today's rates, if a homeowner puts a 10% down payment on a home priced at the national average of $696,166, with a 5-year variable rate of 4.85% over 25 years, the monthly payment would be $3,702. A rate cut of 0.25% would reduce this payment to $3,611, saving $1,092 annually. A 0.50% cut would lower the payment to $3,522, resulting in $2,160 in annual savings. It's important to note that the average home price in Ontario is higher than the national average, standing at $878,620. Graham also mentioned that with several more rate cuts anticipated in 2025, The rates for savings and investment products will likely continue to decrease, which means clients might see a smaller rate of return in the near future. The first Bank of Canada interest rate announcement for 2025 is scheduled for January 25th. Homebuyers and investors alike should keep an eye on these developments to adjust their financial strategies accordingly. In 2025, mortgage borrowers renewing their loans with the Royal Bank of Canada will face an average increase of $513 in their monthly payments, according to a recent report by RBC. This substantial hike comes despite the recent interest rate cuts by the Bank of Canada. RBC projects that a total of $353 billion worth of mortgages will be up for renewal from 2025 to 2027. Most of these borrowers had secured low fixed rates during the pandemic, and now they are expected to renew at much higher rates. Borrowers renewing their mortgages in 2025, who currently have an average rate of 3.60%, are expected to experience a 22% increase in their monthly payments. Those renewing in 2026 will see a rise of 18% on average, and borrowers in 2027 will face about a 10% increase. This situation presents a significant financial challenge for many homeowners as they adjust to the new payment structure. Similar to Scotiabank's recent quarterly results, RBC has also reported an increase in mortgage arrears. The bank disclosed that 0.26% of its mortgage portfolio is in arrears by 90 days or more, up from 0.24% last quarter and 0.15% a year ago. The percentage of gross impaired loans has also risen slightly. RBC anticipates that these impairments will continue to rise, especially given the current economic conditions marked by a weak economy and rising unemployment rates. Graham Hepworth, RBC's chief risk officer, commented on these rising pressures, stating that they are expected to persist into the second half of 2025. He highlighted that the peak in loss rates is expected by mid-2025, largely influenced by unemployment rates, interest rate changes, and fluctuations in real estate prices. However, he noted some optimism due to the recent rate cuts, which have alleviated some of the risks compared to a year ago. Despite the challenges, many RBC clients have shown resilience, thanks in part to the significant equity they have built in their homes. This equity provides them with more options to manage their financial obligations effectively. RBC has set aside $840 million in provisions for credit losses this quarter to cover potential loan defaults, reflecting the bank's proactive approach to managing these risks. RBC has also reported a significant drop in remaining amortization periods due to the Bank of Canada's rate cuts in the fourth quarter. The bank noted that the share of mortgages with amortizations over 35 years has fallen to zero, down from 18% in the previous quarter. This has been largely attributed to the use of fixed-payment variable rate mortgages, which allow more of the payment to go towards the principal when interest rates drop, thereby shortening the amortization period. RBC's earnings report for the fourth quarter highlighted a net income of $4.4 billion, an 18% increase year over year. The bank's residential mortgage portfolio has grown to $408 billion, with a significant portion being uninsured. RBC has maintained a strong capital position with a CET1 ratio of 13.2%, underscoring its financial stability despite the economic challenges. RBC's president and CEO, Dave McKay, emphasized the bank's commitment to maintaining a disciplined growth strategy amidst intense competition. He noted the bank's investments in technology and artificial intelligence to improve client value and productivity, particularly in the digital renewal process for mortgages. McKay also commented on the bank's acquisition of HSBC Canada, expressing confidence in achieving expense synergy goals. In the third quarter of 2024, the Greater Toronto Area's condominium market experienced some noteworthy trends, primarily influenced by relatively high borrowing costs. The Toronto Regional Real Estate Board reported a decline in sales year over year, accompanied by an increase in the number of listings. This scenario provided buyers with more choices and negotiating power, resulting in a slight decrease in average selling prices. According to Jennifer Pierce, the president of the Toronto Regional Real Estate Board, while condo sales remained low during this period, there is an expectation for market conditions to improve. She highlighted that the positive impact of ongoing interest rate cuts could motivate more renters to transition into home ownership. This shift is anticipated as these households begin to take advantage of reduced borrowing costs and lower home prices, making their monthly payments more manageable. The total number of condominium apartment sales in the third quarter amounted to 4,204, marking a 4.4% decrease compared to the same quarter in 2023. Meanwhile, 14,721 new condo listings were added to the multiple listing service system, representing a 10.6% increase year over year. With this increased supply, the average condominium apartment price fell by 3.3% annually, reaching $692,672. In the city of Toronto specifically, the average condo price was $713,801, down from $737,035 in the same quarter of the previous year. Jason Mercer, the chief market analyst at the Toronto Regional Real Estate Board, noted that as market conditions begin to improve in the coming months, the large inventory of listings accumulated over the past year will start to be absorbed. This absorption is expected to lead to tighter market conditions and renewed price growth as we progress through 2025. In recent news, former Bank of Canada Governor Stephen Poloz has expressed his belief that Canada is currently in a recession. During a webinar on Tuesday, Poloz highlighted that the country's population growth has contributed to a somewhat misleading perception of the economy's health. He argued that immigration has skewed economic data, making it appear as though the economy is stronger than it actually is. Poloz stated, "I wouldn't even call it a technical recession. A technical one is a superficial definition that you have 2 quarters of negative growth in a row, and we haven't had that. But the reason is because we've been swamped with new immigrants who buy the basics in life, and that boosts our consumption enough." Statistics Canada recently reported that the national economy expanded at an annualized rate of 1% in the third quarter of this year, falling short of both the Bank of Canada's expectations and those of economists surveyed by Bloomberg. This growth rate marks a significant slowdown from the 2.1% growth seen in the second quarter, which Poloz dismissed as a pop-up and a pretty minor thing amidst a rapidly cooling economy. Poloz also pointed to a higher cost of living due to an inflationary spike in recent years as a factor hindering consumer spending. He noted that a larger-than-expected drop in inflation, which has occurred in recent months, typically only happens during a recession. Looking ahead, the Canadian economy faces additional challenges as the Bank of Canada prepares for its next decision on interest rates scheduled for December 11th. A potential threat looms with U.S. President-elect Donald Trump's proposal to impose 25% tariffs on all Canadian imports. This development could impact the Bank of Canada's decision-making process as they weigh the need to address inflation concerns. Poloz commented on the situation, stating that such tariffs could place the Bank of Canada and other global central banks in an awkward place, potentially forcing them to keep rates higher for longer, even as the economy slows. "I think most central banks are going to say, 'I've got to be worried about the inflation part,'" he said, suggesting that this could lead to deeper stagflation if tariffs are enacted. As we keep an eye on these developments, it's crucial for both homeowners and investors to stay informed and consider how these economic conditions might affect their financial strategies. As always, consulting with financial and mortgage experts can provide valuable guidance during these uncertain times. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit Realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.